Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya, filling in for Andy Bell this week. And now let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Bell Canada is selling its land mobile radio network services business to Motorola in a deal worth $675 million. The business provides two-way communication services such as walkie-talkies and push-to-talk systems. Motorola's CEO says the acquisition will help to protect long-term resiliency. The deal is expected to close in the fourth quarter of 2026. And of course, BC is the parent company of BNN Bloomberg through its Bell Media division. Ontario's projected deficit is almost double what was originally expected, with the government now suggesting it will be more than $13.5 billion in the current fiscal year. The updated figure is up almost $8 billion from what was laid out in last year's budget. The province is citing trade tensions and geopolitical forces as driving factors behind the increase. And we'll find out more about Ontario's fiscal situation and outlook when we speak with Ontario's Finance Minister, Peter Bethlenfalvy. That's coming up on The Open this morning at 10 a.m. Eastern Time. And the maker of Jack Daniel's is in talks with French drinks company Pernod Ricard about a potential merger. The talks come as the alcohol industry faces a downturn due to tighter consumer spending. Both companies are valued at more than $10 billion and have described the discussions as a merger of equals. The deal would bring together Pernod's top sellers, including Jameson Whiskey and Absolute Vodka, with Brown-Forman's brands such as Ford's Gin and Herrera Tequila. All right, we're going to take a look at the U.S. futures this morning. This is what we're shaping up to see for the end of this week. And U.S. stocks, at least, have been heading for the longest streak of weekly losses since 2022. Obviously, investors very much watching what's happening in the Middle East, now bracing for a potentially longer war than what we originally expected. The TSX, it lost almost 500 points at the close yesterday, so we're going to be watching to see what happens there today. And of course, we're also watching the price of oil. Prices are driving even higher today as traders brace for what seems to be a potentially longer Mideast war, and we'll be talking about that throughout the day. But what's interesting to watch is gold, which is gaining as Trump pushes back his deadline for securing a deal with Iran by another 10 days. So that's the latest. That seems to be what's making investors a little wary. And we're also going to be watching the loonie today. It's holding steady around its U.S. counterpart today with some modest support from higher crude prices. North American markets are poised to open lower after Thursday's sell-off. The S&P 500 hit a new low for this year, and the NASDAQ went into correction territory. Let's get some perspective. Joining me now is Jason Betts, private wealth advisor at Ameriprise Financial. It's great to have you join us. Good morning.
Good morning. My pleasure.
What are your thoughts on what we've been seeing with the markets this week and what you're seeing today before the open?
Generally speaking, not surprising. We have a geopolitical conflict shock type of event here with Iran and subsequently what's happened with the Strait and with oil prices and gas prices here in the U.S. Markets are probably handling a little bit better than I would have expected. I would expect that we would have probably been in correction territory by now with the S&P 500. But we see this time and time again with, any type of big geopolitical issue. And this is major. This is a big deal. And markets don't like these types of big deals, and markets especially do not like uncertainty. And we find ourselves in the throes of a lot of uncertainty right now. And I think the market also is kind of showing today, with at least so far with the futures coming up here on the open, that it's grown a little bit, I don't want to say tired, but grown a little bit callous to, Trump tweeting some good news or, delaying another deadline, where in the past that usually leads to a rally the following day. We're not seeing that play out, at least so far here in pre-markets.
What's interesting in your notes is you say at some point the market is going to move on from Iran even well before the Iran conflict ends, I'm assuming. That's interesting. Why do you think that, given the fact that this conflict is so heavily tied to the price of oil, which obviously affects the markets a lot?
Yeah, absolutely. I think it, because historically that's pretty much been the case every time there's a conflict like this, is that we get really concerned and bent out of shape not we here specifically, or necessarily even we as investors, but we as, the global public, we get really concerned, especially about energy prices and gas prices. If you really get granular with a 50 cents a gallon increase or a dollar increase at the pump, if that's sustained for the course of a 12-month period, we're really probably only looking at maybe $500 to $800 in additional consumer spending in that area. That's not great, but it's not enough, in my opinion, to move the needle enough. And so, then market strategists and economists start digesting this data more. The conflict or the war continues to go on, and we realize that economically speaking, the sky is not falling, and then the market grows a little bored of covering that, similar to how the market grew bored of covering, Ukraine and Russia eventually, and the market grew bored of covering, even Israel and Palestine until this whole new conflict came in with the United States getting involved materially. So I think that it's something that we want to make sure. It's a reminder we need to make sure that we're diversified and that we're adhering to certain guidelines and principles. And if we're doing those things, then I think we can rest in that and we can just be patient as investors.
So is that kind of what you're telling your investors to do right now, or what you would advise your clients, is to kind of diversify and just be patient?
Yeah, absolutely. I think I'm also telling people what not to do. And what I would tell investors not to do is to not try to time this market or to materially trade this market based on any developments with Iran, oil, gas prices, or anything like that. I think you might get lucky and hit once, and you'll probably get unlucky and burned probably 9 times. And I just don't like those odds. I don't like the probability. And as long as you're properly diversified, I think you'll be good. Historically, the markets have a decorated history of weathering major conflicts and shocks that generally in hindsight seem at the time worse than they actually played out to be. And with right now, what we're seeing right now, that seems to be the case. Obviously, time will tell as things continue to develop.
We've been seeing a bit of a sell-off in chip stocks right now because of some new AI technology. Could that be a disruptor, do you think, in that sector? I mean, what's your thoughts on the AI situation right now?
That's a great question. And the short answer is yes, I do think it could be a disruptor. I think that we've, as investors, have just jumped on this big technology AI train, that it's going to be this money tree, and it's just going to win all day, all year, every day, every year. And historically, as investors, we overbuy the next big thing. We rarely, as investors, think about competition, price compression, rising costs of doing business, and so on and so forth. We focus on how much the thing might sell, and we don't think about the other thing that affects bottom line, which is expenses and competition and those types of things. And I think it's possible that the big technology companies have gotten ahead of themselves in terms of pricing. Investors have had a huge appetite for that, and without doubt, there's great opportunity in the big technology and AI space, and you should have a subset of your portfolio in there. I think investors as a whole are probably overweight in that. Certainly, the S&P is overweight big technology. Mm-hmm. Right now, if I'm not mistaken, the S&P is the least diversified it's ever been. So if you're an investor that's a stock investor that's just buying the S&P, and under the impression that you're really diversified, I don't think that's the case right now. I think you have too much exposure to big technology, and with the smaller firms creating potential competition and price compression, but also these CapEx expenditures that these big technologies have had are very large. They're following depreciation schedules of 3 to 4 years, but then the stuff they're buying could be obsolete in 6 to 18 months. So now we're buying it again, and we're stacking CapEx on top of CapEx, which could lead to a landscape where the cost of these companies doing business is much materially higher than investors initially expected. That could happen. Or the space in general could just continue to grow like crazy, and it's a non-issue. It's really tough to tell. But it's certainly not a good thing in terms of the competition and the price compression and the potential higher expenses.
Okay, we will leave it there. That's Jason Betts, private wealth advisor at Ameriprise Financial. Appreciate your time this morning. Thanks so much.
My pleasure.
Coming up next, we will tell you the high cost of diesel and how it's impacting the trucking business and adding to price pressures. That's next. Stay with us. Welcome back. As conflicts in the Middle East continue, the price of diesel has been soaring. This has significantly impacted the trucking business, and several companies are noticing higher costs for the transportation of their goods. CTV's John Venevali-Rao has more in this report.
For truckers across the country, as they pump pricey diesel into their trucks, the numbers are numbing to look at.
Diesel prices are going very high. It's like huge difference.
At Toronto-based CSA Transportation, they move all sorts of products from clothes to health supplements from its terminals to cities across the country and into the U.S.
Yep, these are all going to be filled up.
The VP of Operations, Rebecca Herbsch, showed us some of the trailers ready to be loaded. And with the price of diesel surging, she says the trucking companies they partner with have been charging them a lot more.
They want to raise their rates. They want a fuel surcharge. Some of them are charging 40, 50, 60, 70. We even saw 80% fuel surcharge one day.
Herbsch says after holding off, her company raised its freight rates on Monday, though hasn't yet passed on the full costs of rising fuel to customers. Still, she says if the war continues and diesel stays high, consumers will soon see the result when items hit store shelves.
It means that the cost of products is going to go up. The more that vendors have to pay us to move their goods, especially cross-border, the more that we're going to be paying for goods.
And for those truckers who pay their own fuel bills, the soaring price is hitting hard. The cost to fill up a truck like this that holds about 1,000 liters of diesel has gone up around $700 since the start of the war. Benit Puri owns 4 trucks and says his fuel costs have gone up around $4,000 a month.
Need to have prices down, man. Just give us a break.
He says his credit cards are getting maxed and wants to see governments cut taxes on diesel.
We're driving trucks. We're providing food. I work for Walmart, right? My company works for Walmart, and we deliver up north, right? So, I mean, we are struggling 24/7. If they can give us some discount on that, some relief on that, that would be great.
With those in the trucking business worried fuel prices will go even higher and warning it will show up in just about everything. John Venevali-Rao, CTV News, Toronto.
Still ahead, we will get an update on the number of tourists coming into and out of Canada in the latest quarter. That report from Statistics Canada is coming up next. The latest tourism report from Stats Canada shows tourism spending rose to nearly $27 billion in the latest quarter. For more, we are joined by CTV's Kamal Karamali. So, Kamal, good morning. What are some of the highlights from this report, just to start?
Hey, good to see you, Lindsay. Yeah, the numbers that just came out just under an hour ago show that tourism is trending in the right direction for the fourth quarter of 2025. That's between October and December, and primarily the headline being that international visitors seems to be on the rise, which is good news in increasing Canada's tourism GDP. So taking a look at the numbers here, you can see it on your screen now. $27 billion was spent on tourism in the fourth quarter of this year, up more than 1% compared to the third quarter. Of that, roughly $20 billion was spent on Canada by Canadians as domestic tourism grew 0.5%. But this is the headline on the right of your screen. It's the international visitors that are driving the growth in spending, more than 3.5%. That's the fastest pace of growth in international tourism in non-visitors coming to non-residents coming to Canada in 2 years. So a big boost here in the fourth quarter during the holiday season. And the tourism industry's GDP growth was up in most industries as well. If we're breaking it down by sector, transportation grew 3.5%. Accommodation was up 1%, just to give you a few examples. And the number of tourism jobs is also on the rise. More than 700,000 jobs generated by tourism in the fourth quarter of 2025. That's roughly 0.5% change. And the sectors that saw the most growth when it came to jobs in tourism, Lindsay, food and beverage, air transportation, and entertainment. So overall, giving you some brief good news for once.
And what feels like the ever relevant question, though, is what impacts are Canada-U.S. trade tensions having on tourism in our country?
Obviously, a very tumultuous year when it comes to visitors, where people are going, the war as well across the Middle East playing a big factor, fuel prices. Well, we are seeing many people choosing to stay in Canada, and that's why we saw such a big, robust number when it came to domestic visitors, but also a lot of U.S. travelers finding Canada a better option, maybe driving across the border. So the Trump administration, the war, soaring gas prices, all playing a factor in Canadians choosing to stay in Canada and spend their money here on local tourism. Lindsay.
Okay, that is CTV's Kamal Karamali reporting live for us on that report. Kamal, thanks so much for the details.
Anytime.
Well, shipping through the Strait of Hormuz remains under intense pressure as the Iran war disrupts one of the world's most critical trade routes. Tehran is now considering introducing tolls for safe passage through the strait, tightening its grip on a key global choke point, while the U.S. prepares to roll out an insurance program to encourage vessels back into the waterway. Earlier, we got some insight from Salim Khan, Chief Data and Analytics Officer at Polestar Global, in a Bloomberg interview. Take a listen.
The new insurance mechanism could potentially provide a new backstop for vessels to potentially move through the Strait of Hormuz. Obviously, war risk insurance has pretty much halted or increased by nearly 1,000% since the start of the conflict. And so introducing this new war risk insurance and insurance capability, $20 billion backstop that the U.S. is introducing, could potentially open up the strait. The other piece of this puzzle is also the question around naval escorts. So will the U.S. Navy and other navies potentially escort vessels that are also insured by this new insurance scheme?
Can I just ask how technically feasible that is? I mean, at one point, the strait is literally only 30 miles wide. How impactful is the naval escort program actually going to be? And could you be also exposing the escorts to the risk of explosions and mines on the strait?
Yeah. Absolutely. I mean, it's a very tenuous situation. It's about a 21-mile stretch there between the border, therefore the Strait of Hormuz. You potentially have the smaller boats that could be mined coming in to hit U.S. naval vessels. Any vessel trying to pass through that has not reached some sort of negotiation or agreement with Iran could potentially be up for being hit by a drone or a rocket attack. It is, from a physical standpoint, a bit unfeasible, right? You literally have two lanes, one lane in, one lane out. It's a 21-mile stretch that you have to go through. And if you're a large VLCC, very large crude container, you steam at about 10 knots, which is about 15 miles per hour or 20 kilometers per hour. And so you're essentially a sitting duck. You're moving quite slowly through that strait.
And I know it's difficult to say at this point, so if you don't have information, that's fine. But do we understand whether the strait is actually mined already? Do we have that information?
We don't know for sure whether it's mined. We do know, though, that there have been a number of attacks in that area. We've tracked 28 distinct incidents in the Persian Gulf, involving everything from vessels being sunk by the IRGC to tankers being set ablaze by the IRGC. And more critically, I should mention, a dozen merchant mariners have been killed. So one big thing we have to remember is that there are about 20,000 merchant mariners that are trapped within the Persian Gulf right now. They cannot leave because of this. But we don't know of any specific mines in the area, but we do know that the IRGC is coordinating attacks, and they seem to cluster right around the Strait of Hormuz, the entry and the exit of the strait.
Yeah, and Celine, let me just ask you something else. It's not just the threat of being harassed or attacked, but there are other maritime threats as well. And we've reported on signal jamming that's been taking place too. What does your own data suggest?
Yeah, we're seeing a number of different techniques being used here, different techniques, but there's three main behaviors that we're seeing. Number one is GPS spoofing, which is where a ship will kind of deliberately falsify its position. So that's number one, and that's really more a deliberate attempt. The second sort of behavior that we're seeing is signal jamming. That's where navigation systems are disrupted by high-frequency radio signals, typically used in missile defense systems. So these missile defense systems can not only interfere with the automatic identification system, the GPS system on these vessels, it could also interfere with everything from an internet-connected toaster all the way through to these vessels' navigation system. And so those are two items we're seeing. The last item we're seeing here from a vessel positioning standpoint is that some vessels are actually turning off their transponders, their AIS transponders completely. This is a very dangerous scenario for vessels because they could be mistaken for potentially being malicious actors by the U.S. Navy and others that are, having bases there in the Gulf area. You could potentially be attacked if you turn off your transponder. So those are the three main behaviors that we're seeing right now.
Yeah, and yet there are a few vessels and a few ships that are managing to make it through. What do we understand about the nature of those vessels and the types of security arrangements that they would have agreed prior to attempting the transit?
Yeah, so what we're seeing, it's really, I would call it a sort of a tale of two risk appetites. We're seeing Western-flagged tonnage or vessels essentially clearing out of the region, but Iranian, Chinese, Indian-linked vessels are still threading the needle through the Strait of Hormuz. And the really concerning part here is these ships are using digital disguises. Every vessel broadcasts its identity through a system called AIS, which I mentioned earlier, the automatic identification system. Think of this as the ship's passport. What we're seeing now is essentially forged passports at sea. These vessels are changing their destination fields mid-voyage to broadcast things like China owner, effectively signaling to the IRGC that they are friendly and they should be let through. We actually verified this just today. There's a tanker called the Bright Gold, which is doing exactly this right now as it transits through the Gulf. So we are seeing some countries have sort of negotiated deals with Iran and are able to safely transit through.
That was Salim Khan, Chief Data and Analytics Officer at Polestar Global. Stay with us. Opening bells are coming up next. Here are the opening bells at the NASDAQ. Xanadu Quantum Technologies is ringing the opening bell. We're going to be speaking to the CEO of that company coming up. At the New York Stock Exchange, Kensington Capital Acquisition is ringing the opening bell. And it's time now for the first 15. This is BNN Bloomberg. Trading is just getting underway, so we're going to check in on the equity markets today. The TSX lost a lot of points yesterday, almost 500, so it's trading down to start the morning. We're going to be watching that closely. It was seeing gains for most of the week, but it seems to be reflecting what's happening in the U.S. as well. You can see the S&P 500, the NASDAQ composite, both down, and we've been seeing these stocks falling to some new lows that we haven't seen in quite some time. So we'll be watching that. There's a lot of skepticism, I guess I should say, around what's happening in the Middle East and how long this war might go on for. And that seems to be reflected in the markets today. If we're taking a look at a couple of Canadian companies, we're watching BCE. Bell Canada is selling its land mobile radio network services business to Motorola. That's in a deal worth $675 million. And you can see BCE is down right now by, it's basically flat at the moment. Also, to keep in mind, BCE, of course, Bell Canada is the parent company of BNN Bloomberg. And we'll take a look at Motorola as well, because this transaction between the two expected to close in the fourth quarter of this year. Motorola flat at the moment as well. We'll keep watching those two stocks throughout the day. We're also watching Marin Energy. This company says it is refinancing some of its debt, so we'll be keeping a close eye on that. And for movers south of the border, we are now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, good morning. It's great to have you join us. So,
good morning. Happy to be here.
Yeah, you're watching U.S. markets obviously closely. The NASDAQ 100 is approaching a correction. Tell us what you're watching there.
Yeah, the magic number here is 23,507. That is the correction number. That would be a 10% decline from the peak, which was recently hit in October. To get a sense of why things have finally gotten to the 10% correction, we need to go back a little bit further. At the end of October, we had this rotation out of these highly valued, at the time, highly valued technology names into other sectors, including energy, including industrials, including materials, and that has kind of begun an unwind in that technology sector. That accelerated in the early part of this year when there were concerns about AI and the potential for things like Anthropic and ChatGPT to unleash these new models that would kind of eat the lunch of the software as a service companies, which has led to a big drawdown in those companies. Now, what we're seeing today, the market almost got there at the end of last night. It's the cybersecurity companies today that are really, really underperforming and may actually drag this thing into the bear market here in the early stages of trading.
It's so interesting. I mean, can we speak a little more about the cybersecurity stocks that are falling after that report, as you say, of a new Anthropic AI model? This is Anthropic shaking things up once again. Which cybersecurity stocks are you watching?
That's right. So Palo Alto Networks, CrowdStrike are the two worst performing stocks in the S&P 500. They were in the pre-market session, and they were down very sharply, 7%, 6%. So worth watching over the course of the day because those are big moves for big companies. What happened overnight is Fortune had a report that said that Anthropic has been testing this new model of its Claude AI tool that has a pretty heavy cybersecurity component. And so if an AI model can do potentially, we don't know exactly yet, but can do some of the things that these cybersecurity companies say they can do, then you have a new entrant, and some of those fears that had been in the market now for a few months really coming to the fore once again for these cybersecurity companies. So as I mentioned, the two that are kind of moving the most are CrowdStrike and Palo Alto Networks, but they're far from alone. Fortinet is another big mover this morning, as well as a company called Zscaler, or we might in Canada call it Zscaler. It's just the letter Z and then Scalar. Both of those also falling so far this morning. The whole group down, getting hit really hard as a result of that report, which Fortune magazine did say that Anthropic has confirmed they are indeed working on this model.
Interesting stuff. Okay, we'll have to see what happens next there. That is Bloomberg's Jeff Morgan joining us live. Jeff, thanks so much. Appreciate it. Coming up, we've got a bullish case for gold. Stay with us. That's next. Gold has seen some gains after dropping in 10 of the past 12 sessions. Our next guest says gold still stands out as a highly liquid, time-tested diversifier when markets are volatile. So joining me now is Joy Yang, head of product management at Market Vector Indexes. It's great to have you join us. Thanks so much.
Thanks for having me.
So gold typically thought of as kind of like a safe haven. Why have we been seeing it sell off so much over the last couple of days and weeks?
I think it's important, number one, for investors to remember that just because something is a safe haven or a defensive asset does not mean it's not volatile. So I think, what we're seeing now with gold falling and really high volatility seems counterintuitive, especially when we expect gold to be rising with wars. But I think we're not seeing a case of investors trying to, play out the bull and bear case for gold. We're really seeing the investors trying to play out the short versus long-term case around what's happening in the markets now. And I think right now this war has come with the supply shock and rising prices as well as a liquidity squeeze. So investors are trying to take cash out where they can. And with gold, rising over 2025, hitting all-time highs in 2025, gold is an easy liquid place for investors to take out cash and pay for bills and pay for military expenditures that they need.
Is it possible too? I mean, we saw gold hit like record highs at the beginning of this year. Is this kind of a correction that was needed anyways for the metal?
So I think anytime you see some of these parabolic rises in price, you're going to attract speculators and essentially FOMO players. And these type of players, what do they want to do? They want to take the money and run. So at, when gold peaked, this was a natural place also for people who want to take profit out of the system, deleverage, and really cash out. So this is, everybody was waiting for this moment, but at the same time, the long-term case for gold still stands.
And when it comes to gold, what's the investment takeaway?
I think you have to think whether you're in gold now or just thinking about should you start allocating to gold. You have to think about the long-term strategic plays that are driving gold and will still hold gold up. And those are essentially, there's still increasingly geopolitical instability, a weakening dollar, and resilient inflation. So those dynamics have not changed, and they will continue to support gold. So I think in those cases, investors who can stay for the long run and who think of gold as a diversifying asset, there's still a strong case for gold.
Other than gold, where are you seeing opportunities in the market right now?
So of course, with gold, gold miners are an interesting play on gold. They're a leveraged play on gold, and they are exposed to equity characteristics. But also, thinking about gold and its role as a diversifier in portfolio, we look at the other alternative assets, whether they're business development companies, private equity, and private debt, which have been beaten down, but not all of these cases should be beaten down. So I think investors that want to seek an alternative play on diversifying their portfolio should look at diversified ways of looking at business development companies. Also, along with gold, we have digital gold, which is Bitcoin. Again, gold has the advantage of having thousands of years of attracting a strong investor base, whereas Bitcoin is still evolving and trying to balance speculative players with institutional players. But it serves very similar dynamics and characteristics to, the qualities that people want in gold.
And Bitcoin is something you're going to be watching for this weekend. Why is that?
I think because Bitcoin prices out of market hours in real time, and we're seeing it, pricing the real time market sentiment. And we look at where Bitcoin had been, and we're looking at we're monitoring our crypto heat index, which looks at not just Bitcoin, but the rest of the crypto industry. And we're seeing breadth and depth in all of the tokens kind of coming out of this fear territory, and now, monitoring and digesting news over the weekend and outside of market hours.
Going back to finding other opportunities in the market, what are your thoughts on emerging markets? Is that a good opportunity for investors?
I think emerging markets are an interesting place also for investors to look at because they've been undervalued for so long. And it's interesting to see how resilient they have been through previous global economic shocks, through this tariff uncertainty. That they've been quite resilient in being able to pivot and shift opportunities and away from kind of what we thought was, really or like a downside case for emerging markets, and we can't think of all emerging markets as a homogeneous pool. So obviously markets that are more commodity sensitive and importing commodities will be hurt a little bit more, but we've seen them being able to pivot. So those are Asian emerging markets versus Latin American emerging markets, which have a strong case given that they are commodity exporters.
So, sorry, just correct me if I'm wrong. Are you saying maybe stay away from Asian emerging markets right now, or those are the ones?
I think they're a good place to look at the opportunities if they can pivot out of, some of the rising costs around oil and food as well as manufacturing, because this, but if they can pivot very quickly, whether it's realigning themselves with China and other players, this is still an interesting place to look at.
Just lastly, looking at the markets as a whole, I wonder what your take is on the direction of the markets right now. We've seen the NASDAQ hit correction territory on Thursday, U.S. markets in particular lower than they have been in some time. Do you think this was a correction that's needed?
I think people are reacting to news at the moment, and sometimes there can be a market overreaction to headlines. So for investors, looking at the equity markets historically has always, gone past some of these geopolitical shocks. So we have to look for the long-term case, whether it's for technology or other parts of the market. But I think it's for investors trying to time some of these headlines is not going to be a strategy that bears out well. So I think it's still prudent for investors to think about staying invested, but being in a diversified portfolio strategy.
Okay, we will leave it there. Joy Yang, Head of Product Management at Market Vector Indexes. Appreciate your time. Thanks so much for joining us.
Thank you.
Today on Market Call, we will be joined by Brianne Gardner. She is Senior Wealth Manager with Velocity Investment Partners at Raymond James, and she'll be taking your questions. And yesterday on Market Call, we were joined by Eric Nuttall. He is partner and senior portfolio manager at 9 Point Partners, and his focus was energy stocks. These were his top picks: Strathcona Resources, Whitecap Resources, and Ovintiv. Just ahead, we will update you on the markets as we see considerable selling pressure on North American markets. Stay with us. Welcome back. We are going to take a look at the U.S. markets today. U.S. markets headed for the longest streak of weekly losses since 2022, all trading down at the moment. Same with the TSX, down by 0.2% to start the day. The TSX seeing lots of gains throughout the week this week, but yesterday closing at almost 500 points lower. So we're going to keep watching that. Investors very much watching what's happening in the Middle East, very wary of a potentially prolonged war in the Middle East. And speaking of the TSX, here's a year-to-date view of the TSX. So far this year, it's down by 0.1%. So overall, erasing some gains that it saw earlier this month. And we'll continue to watch that. When it comes to the biggest sectors on the TSX, though, we're seeing TSX Materials, TSX Financials, and TSX Energy. Materials and energy are both boosting up. This obviously makes sense, especially for energy, given those high oil prices we're seeing right now. It's benefiting Canadian energy companies. But TSX Financials is down by 0.9%. And speaking of oil prices, we're keeping an eye on that today. Oil prices even higher. They're up by more than 3% at the moment as traders brace for what seems to be a potentially longer war in the Middle East, which obviously means that the Strait of Hormuz could be closed to most traffic for longer than hoped, which will keep those oil prices driving up. Also, a lot of infrastructure in the Middle East has been damaged at this point because of airstrikes from both Israel, the U.S., and Iran. If we look at the price of gold, it's also gaining today. Donald Trump is pushing back his deadline for securing a deal with Iran by another 10 days. And it seems as though that's reflecting on the gold market. Gold up by more than a full percentage point to start today after seeing some losses over the last couple of weeks. And the loonie is also holding steady around its U.S. counterpart today with some modest support from higher crude prices. So it's down ever so slightly, basically unchanged at the moment. And here is the VIX index. That's a reading of global volatility, up by more than 6%. So from markets to military spending, a large part of Carney's federal budget is focused on defense spending, and Petawawa, Ontario is a military town where locals are hopeful that this increase in spending will foster a strong economy. CTV's Mike LeCouture has more in this report.
Without the military, this town really doesn't have a full-fledged economy.
It's why Richard McNish is welcoming news that Canada met its NATO spending target. The former member of the Canadian Armed Forces has spent most of his life in Petawawa, and now he runs a business in the military town. But all of that experience has also left him skeptical.
They'll say one thing, but then another is done. Hopefully, this comes through.
In 2014, $20 billion of military spending got the country to 1% of GDP. 10 years later, it was doubled, but still fell short. In the last fiscal year, nearly another $20 billion hit the target. However, the new goal would be to spend $150 billion. A part of that is the pay raise to military members.
More money in the pockets equals more purchasing power, which drives more activity and presence in their local communities.
Last month, the federal government earmarked $3.7 billion to build 6,000 new military homes, 1,000 in Petawawa.
No problem.
Something this restaurant owner believes will help the community.
A healthy military, it will make a healthy town.
Now, other than the housing money, it's unclear how the budget for CFB Petawawa will be affected. But a spokesperson for the Department of National Defense tells CTV News they could have more to say on that in a few weeks. Mike Lecoulteur, CTV News, Petawawa, Ontario.
Up next, we will tell you how the AI build-out is benefiting plenty of companies beyond Silicon Valley. That's next. Stay with us. The AI build-out is benefiting plenty of companies beyond Silicon Valley. A growing list of century-old businesses are cashing in on the AI boom. BNN Bloomberg contributor John Ehrlichman joins us with more on how investors are positioning around that trend. So, John, good morning. What more can you tell us?
Good morning. Well, it's interesting, Lindsay. I think even in Silicon Valley these days, they're having a moment of reflection because for so many years as operators and even on Wall Street, there was basically tech and non-tech. There were companies that were leading us into the technological age and then all the old economy businesses. But I think now more than arguably ever, you are seeing all industries come together as part of the AI story. And so in our latest Ticker Take, we spoke with Steve Rolls, who's a longtime investor who likes the AI boom, but he likes it the most through investing in companies that have very reliable old businesses, but that are, as you mentioned, cashing in on the AI boom because they're part of the entire ecosystem. We need lots of power. We need lots of metals. We need lots of machinery to help build all of this out, including the data centers. And then once the data centers are built, you need all sorts of companies that have been around for a long time that have all these areas of expertise, including cooling. And one of the reasons Steve likes these individual companies, Lindsay, and we've got a full write-up on the website, is that not only do you have perhaps a less up and down sort of reality that sometimes lives with hot growth stocks, there are also companies that have been around long enough to know that they need to appease investors in different ways. So a lot of them are really religious when it comes to dividend growth as well.
Okay, so what would be some examples of so-called old stocks that are tied to this trend?
Yeah, actually, Steve gave us a list of 13 names in total, and people can check out the full list on bnnbloomberg.ca. But a couple examples just to walk you through. So let's talk about General Electric for a minute. For the longest time, we talked about GE as a left for dead company. Then they basically split things up, and the investor story of GE is reborn. You have different components that are now publicly traded, including GE Vernova, which is the power assets that they amassed over the years. And so right place, right time to have that kind of business when power demands are through the roof. Now, you can see that this stock has had a massive run even over the last year, but the projections for growth are quite impressive. And even if you look at what Bloomberg's own data projects on dividend growth, they expect sizable increases in payouts to investors over the next few years. Anyway, Steve likes that one. He likes Vertiv, another example of a company that we're not early into the investing story of Vertiv. This is a company that has cooling tools that help from overheating in the data center. But again, a company that is seeing its business grow right now, and dividend growth is expected as well. And then a third name, which we've actually had a number of guests on Ticker Take. I know people have mentioned on BNN recently as well, Caterpillar, which obviously, with all the infrastructure build out around the year, really started to catch the eye of investors. Like a lot of names recently, it's seen some choppy action, but it too is expected to see some dividend growth. So those are three names out of 13 that Steve is eyeing. Most of these companies have, at least their roots have been around for more than 100 years.
So interesting. Okay, John, thanks so much for that. Really appreciate it. You can find John's full story on our website and on the Ticker Take YouTube channel and podcast. Thanks, John. When we come back, we will find out more about Ontario's fiscal situation and outlook from Ontario's Minister of Finance, Peter Bethlenfalvy. That conversation coming up after this. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Ontario's projected deficit is almost double what was originally expected, with the government now suggesting it'll be more than $13.5 billion in the current fiscal year. The updated figure is nearly $8 billion higher than what was laid out in last year's budget. The province is citing trade tensions and geopolitical forces as driving factors behind the increase. Bell Canada is selling its land mobile radio network services business to Motorola in a deal worth $675 million. The business provides two-way communication services such as walkie-talkies and push-to-talk systems. Motorola's CEO says the acquisition will help protect long-term resiliency. The deal is expected to close in the fourth quarter of this year. And BCE is the parent company of BNN Bloomberg through its Bell Media division. And shares of Brown-Forman are getting a boost today. The maker of Jack Daniels is in talks with French drinks company Pernod Ricard about a potential merger. Both companies are valued at more than $10 billion, and the deal would bring together Pernod's top sellers, including Jameson Whiskey and Absolute Vodka. The talks come as the alcohol industry faces a downturn due to tighter consumer spending. We're watching the markets today. The TSX saw some losses yesterday. It seems as though that might be the way it's going to go, at least for the start of the morning today. The TSX down by 0.3%. Similar story in the U.S. markets, with investors very wary about when this war in the Middle East could end after an extended deadline from U.S. President Donald Trump, another 10 days for Iran and the U.S. to reach some kind of a peace deal. And that's reflected on markets today. The Dow Jones is down almost a full percentage point. The Nasdaq down 1.3% at the moment. Ontario's 2026 budget is forecasted to be nearly double initial expectations, jumping from $7.8 billion to $13.8 billion. The budget lays out increased spending for healthcare and tax breaks for home buyers and small businesses. For more, here's CTV's Siobhan Morris.
It's once again called A Plan to Protect Ontario, a budget delivered a year after U.S. tariffs were introduced. Ontario's in for deeper deficits for longer, even though tariffs didn't squeeze the province's economy as much as feared.
Our plan is cautious where it must be and ambitious where it should be.
The government projects a deficit of almost $14 billion this year, significantly more than the $8 billion predicted in Budget 2025. Next year, a $6 billion deficit, with a return to surplus in 2028-29, a year later than previously planned.
Of course, I'd prefer to have a smaller deficit. I'd prefer to balance sooner, but we have to live in the world we're in.
A world Bethlenfalvy says still has a lot of challenges. You've already heard some of the promises in this spending blueprint. $6 billion more for colleges and universities, with an overhaul to OSAP and the end of a tuition freeze. Accounts for elementary teachers to buy classroom supplies. More cash for primary care. And waiving the HST on new home purchases for all buyers for 1 year. But here's what's new. A 1% income tax cut for small businesses. An extra $1 billion for home care over 3 years. $186 million more to the Ontario Autism Program, and $41 million for a program that puts police officers in schools. The government is also setting up a new $4 billion investment fund, working with a private manager to find companies that line up with the province's economic priorities. Think defense, data centers, and tech companies.
Come up with great patents and intellectual property. And then investors come from around the world and buy up those patents and move the offices to wherever to the U.S., Silicon Valley, move the talent. I want that to stay here.
The opposition feels government priorities are out of line with people struggling to make ends meet.
This budget was an opportunity for Doug Ford to choose a stronger, more affordable future for Ontario. What we heard instead was stale announcements, more cuts.
There's frustration over government excitement for new highways, an expanded Toronto Island Airport, a possible tunnel under the 401.
These projects are so irresponsible that the government talks about them in the budget and never assigns dollar figures to them because they're too embarrassed.
The Liberals flipped the name of the budget and the government's motto.
They're pretending. They're not protecting.
There's no money attached to these things, but the government is looking at the possibility of standardizing rules for ride-sharing programs and ways to protect your loyalty points. At Queen's Park, Siobhan Morris, CTV News.
Okay, let's bring in Peter Bethlenfalvy, Ontario's finance minister, for more on this latest budget. Minister, it's good to have you join us this morning. Thanks so much.
Good morning.
So the deficit up $13.8 billion for the next fiscal year. We heard a little bit about that from Siobhan in that report we just aired before you. But what are the main factors driving up the deficit so much?
Well, I think there's three things. We're definitely in a softer economy. I mean, that's a global trade turmoil and now global conflict. So clearly, right around the world, softer economy. The second component would be our population in Ontario has grown by 2 million people in the last 8 years. That's a good thing, but of course the majority of expenditures fall on the province to fund the supports for those people, healthcare, education, social services. So that's impacting our investments and our costs. And thirdly, we've chosen to cut taxes for people and for businesses, putting more money back in their pockets, just like we did yesterday, announcing the small business tax cut, 375,000 businesses that will benefit from a 30% tax cut. They'll create more jobs, they'll grow the economy. So those are some of the factors. It's the world we're living in and some of the choices we're making here in Ontario to protect people and protect businesses.
Difficult choices, I'm sure, to make. I want to talk about that tax cut for small businesses in just a moment, but are you comfortable with the size of this deficit? I take your point that decisions needed to be made because of the state the economy's in.
No, I would like to balance sooner. I think deficits are temporary and should be temporary, but relative to other provinces and other jurisdictions around the world, frankly, we have some of the lowest deficits relative to our economy. And don't listen to me, listen to the credit rating agencies who have upgraded our credit rating over the last couple of years. And also the relative size. I mean, BC had a $13 billion deficit as well. We're 3 times bigger than them, and we have the same size deficit. So I think we're being prudent fiscal managers, but at the same time, leaning into building infrastructure, leaning in to make sure investments are made for the people of Ontario, and at the same time, supporting businesses and the economy with tax cuts.
Okay, so let's talk about the small business tax cut first of all. It's estimated to be about a $5,000 tax break for small businesses. Is this going to be enough, though, given the state that many small businesses find themselves in? Especially last year, there was that $9 billion in temporary tax deferral relief that was kind of had low uptake. So what did you learn from that last year? And is this actually going to be enough for small businesses this time?
If we could just look back to the supports that we gave last year, so 2 billion companies took us up on the tax deferral, so that helped with liquidity. That's a meaningful amount of money. Another 2 billion through WSIB rebates. That's a meaningful amount of money that went into the pockets of the businesses and small businesses right across Ontario. And I would say, yes, this is a significant tax cut for small businesses. Supported by the Canadian Federation of Independent Businesses and many other stakeholders across the province. This will really spur economic activity. And I would add, we had another tax cut yesterday that we announced, the HST rebate, some 13% on new homes. This will spur housing activity. It's a huge affordability measure for families, but it's also going to spur construction jobs, 21,000, and a growth in our economy, according to economists, of $2.7 billion. So we've got a plan that really is fiscally responsible, invests in infrastructure, invests in our social infrastructure, but also boosts the economy.
There's also more than $100 billion going into healthcare. So what improvements can people actually expect to see on the ground in hospitals and in other healthcare settings?
A couple areas. For instance, we're really leaning into home care. I haven't met anyone that doesn't want to age at home. So transforming our system to be able to deliver some of that care, be it a nurse, a PSW, a doctor, to the home. So we're continuing to make record investments to allow that transition to happen. Investing in primary care, we announced yesterday $3.4 billion to put more money getting family doctors to every person who wants a family doctor in Ontario. We lead the country in that regard, but there's more to do. So these are the types of investments that we're making to ensure that people are taken care of, not only in the right place, but it's also good economic policy, because if people are healthier, that's good for their social quality of their lives, but also their economic opportunities.
For sure. But are there any investments going to like hospitals and particularly ER rooms?
Again, record investments in hospitals. I mean, our hospital investment is up some 55% since 2018. You haven't seen an increase like that ever, I think, in Ontario. An additional $1.1 billion announced yesterday. But my message to hospitals, well, and they've been doing a great job to innovate, think outside the box, deliver, use technology to cut the paperwork, cut administration and red tape, deliver more for our frontline doctors, our nurses, our personal support workers, for the benefit of patients. There's a lot of opportunity there. They've been great partners in that, but there's more to do.
Okay, so we'll move on. Removing the HST on new homes will cost the province $1.4 billion. That was announced yesterday, expected to generate about 8,000 new housing starts. Is that level of spending, $1.4 billion, justified, given such a relatively small number of new builds will come out of that?
Well, I'm sure you've talked to many of the stakeholders. They've said they're calling this a game changer. Experts right across the spectrum, whether people in the industry, construction workers, policy think tanks, they're saying this is a game changer. As I mentioned, a big boost to the economy, a big boost to construction jobs. You know, I was with the Premier on Wednesday and I met a lot of the construction workers. I've never seen them smile so much. You know, our construction industry has been hit with the slowdown in housing construction. So this is a big shot of stimulus into the housing sector, all at the same time providing an affordability measure for many families who are dreaming of buying a new home, be it a townhouse, a condo, or a detached home. So this is really, I think, what the market wanted, and we heard, we listened, and we're delivering.
The budget also sets up a $4 billion Protect Ontario account investment fund. It's managed privately, though. So how will the government ensure those investments align with taxpayers' priorities?
Well, first off, the principle that we wanted to signal yesterday with the Protect Ontario Investment Fund is that we want to bring in not just the government's money, but other private sector money to invest in companies that are creating jobs here in Ontario so they don't leave Ontario. We've got great companies in AI, defense manufacturing, energy in the nuclear space, critical minerals, life sciences, advanced manufacturing. So we want those companies to grow, find new markets to export, to diversify trade. And so that's the purpose of that. We'll continue to work on details over the months to come. We're setting it up much like we did the Building Ontario Fund, which is our infrastructure bank, which is the same model, arm's length with a board and a governance model to bring in other investors to get long-term infrastructure done. That's done deals in the long-term care sector. It's done deals in student housing, affordable housing, and also nuclear energy through the small modular reactors. So this is the type of out-of-the-box thinking that we need at this moment in time, given the evolution of our economy and the global trade system. I think these are the smart type of investments which will propel Ontario's economy and continue to create really good-paying jobs for the workers in Ontario.
Just before we wrap up, you've mentioned a number of different areas where you could be investing some of those funds. Is there any priorities in terms of where those investments will go?
Well, those are the priorities. I would just maybe go another level for nuclear energy, for example. That's going to create a lot of opportunity in our small modular reactors, new nuclear build, the Pickering refurbishment in my riding for nuclear stations. I mean, that's going to create, just in Pickering, 30,000 new jobs, a tremendous amount of economic activity. And the technology and the supply chain around nuclear, I mean, the world is envious of what Ontario has. And so that's an advantage. I would just add the critical minerals, another area where Those minerals are all here in the ground in Ontario. You have to go to far-flung places to get those minerals, like China or parts of Africa. We have them right here in Ontario. We have a real advantage. We've got incredible talent, mining expertise. These are good-paying jobs, so we're going to lean into areas such as critical minerals as well.
Okay, we'll leave it there. Peter Bethlenfalvy, Ontario's Finance Minister, joining us live. Appreciate your time, Minister. Thank you.
Thank you, Lindsay.
Coming up, we will turn our attention back to the markets with Andrew Sliman after this, head of the Applied Equity Advisors team at Morgan Stanley Investment Management. Stay with us. Markets remain on edge despite the Trump administration's move to extend its Strait of Hormuz deadline. Uncertainty around the conflict in Iran and several other risks is keeping investors cautious. So here to break it down is Andrew Sliman, head of the Applied Equity Advisors team at Morgan Stanley Investment Management. Great to have you join us today. Good morning.
Good morning to you. Thanks for having me.
Okay, so the war in Iran clearly still weighing on markets today, but you've said there's other issues that investors should be thinking about as well. What are those?
Well, I mean, even before the war started, we had concerns on AI disruption. Like as I like to say, the AI Pac-Man was going to eat away lots of different industries. That's very consistent with the early stages of new technology innovation. The market worries first about who the losers are, doesn't focus on the winners. So that's brought down various industries, especially software. And then we have a lingering private credit issue as well. So we put three issues together, and it doesn't surprise me the market's now down about 8%. And you layer that in with the fact that we started the year with a lot of optimism, which is kind of classic late cycle. People go from being too bearish early in a cycle to too optimistic, and you have these issues and you put them all together and you get a kind of a washout. That's what happened last year with tariffs, and I think that's what's happening this year.
I want to talk a little bit more about your concerns about the pace of the AI rollout and what exactly, like you touched on it, but what exactly is maybe concerning you? And is that a bigger concern to you than what we're seeing in the Middle East and the price of oil?
Well, I mean, the point of the rollout of AI is there will be losers. Most companies will benefit. And if you look back to the S&P from 95 to the dot-com bubble peak, the S&P doubled. The Mosaic browser was rolled out in 93. But early 1995, 96, it was all about, oh my God, newspapers are going to lose, publishers are going to lose, big books are going to be losers. And what ultimately happened was AI for most companies enhanced margins, profitability, and that's why the S&P did so well. And I think that's still the case today. And what gives me confidence is I don't see Wall Street analysts raising estimates because profitability is going up for a lot of different industries. They haven't done that yet, but we've focused on the losers. So I think it's very consistent with the early part of a technological revolution, innovation, call it what you want. And so I'm more confident in the ultimate benefits of artificial intelligence than the disruptive change, but I think it's just where we are in the cycle.
We have seen, though, some stocks, some sectors hit hard by the AI kind of rollout. Software earlier this year, cybersecurity stocks are down today after reports of a new Anthropic AI model. So for investors who are maybe unsure what to do with their tech holdings because they're worried that AI could kind of disrupt some models, what's your advice?
I would be very careful. I wouldn't step in and buy the software companies just because they're down a lot, because I think there will be an effort by a lot of companies to replace software packages with, artificial intelligence. So I would be very, very careful. I would much rather try to focus on the winners, and that could be some of the tech companies, but I think there's a lot of winners in other industries that are being pulled down for other issues, whether it's, especially the war in Iran.
And you've also flagged anxiety around the private credit liquidity as well that we've been seeing recently. How are you thinking about that risk?
Look, I think there's a bigger tail risk to private credit than there is to AI disruption or the Iran war. And the tail risk is that if you look at all, most all bear markets, they're caused by leverage, too much leverage. And clearly there is some leverage into the private credit issue. I don't think this is a big deal yet because the leverage by the private banks lending to private credit is not that high. But I think this is a lingering issue primarily because private credit, you get a term premium on loans by lack of liquidity, but then they turn around packaged and sold them to retail that thought they would have better liquidity than they thought. So that's a liquidity problem. It's not a credit problem. But if it morphed into a credit problem, then there is leverage. So I think there is tail risk. I suspect this issue is going to go away for a while because it's what's front and center right now is where it's because of these funds being forced to be gated. I think that'll go away to the next time the gates open, and then they have more drawdowns, and we'll get anxious again about it.
Okay, so let's talk about oil and energy stocks briefly. With everything happening right now, do you think it's a good time for investors to be adding exposure in that sector?
No. If you look at the history of energy stocks, they spike initially on the surprise, on the big move up in oil prices. And while oil, if you look, probably will come down, it's not going back to where it was for quite a while. But the energy stocks tend to peak early in a price hike. So I think it would be a mistake to chase them. I'm not, as I said, I'm surprised the market's not down more near term, but I don't think running into defenses or running into energy is the right move right now.
Okay, we will leave it there. Andrew Slimman, Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. Appreciate your time today. Thanks so much.
Thank you.
Coming up, the 55th Annual Juno Awards will take place this Sunday. And as we get ready for the biggest night in Canadian music, we will get an update on the state of the Canadian music industry. That's next. Welcome back. Ahead of the Junos, we go beyond the red carpet to the business of Canada's music industry. Is Canada riding a global wave or getting squeezed by streaming giants, rising costs, and AI disruptions? To discuss this further, we were joined earlier by Andrew Cash, president of the Canadian Independent Music Association.
I think people are excited about Canadian music, and it's always great to to bring the community together because really the Canadian music industry is a fairly tight knit and relatively small in the grand scheme of the music business globally, a small tight community.
And you mentioned about the optimism. Where's the optimism coming from?
Well, in your setup, I think you've accurately portrayed the situation. It's both a time of pretty interesting opportunity for Canadian music, and also we're heading into a lot of tricky waters. I think both on the regulatory front, on the legislative front, but I think for a lot of Canadian-owned music companies, if we can just speak about them, because that's the folks that I represent. It's tough making a business of it in Canada, just because of just the market, and with trade tensions as they are right now south of the border, many music companies are looking to try to find audiences all over the map, and streaming platforms have never made it easier to do that. At the same time, it is also very difficult to do that on those platforms. So I think for Canadian companies, the challenge is really getting, your elbows up, as it were, and really duking it out toe to toe with global competitors on global streaming platforms. That's what we do in Canada. That's how we build audiences, and that's how really Canadian music has been really has found audiences all over the world.
I guess in a world of streaming revenues, I'm a concert kind of guy. I love to go out and watch a concert. I've had the pleasure of seeing a few concerts outside of Canada. But, are concerts still profitable? Are you going to still see these artists go on the road and tour around? Obviously, a few years ago, we saw Taylor Swift. I was fortunate enough to take my girls to see a Taylor Swift concert. But obviously, that is a rare thing to see. But in a world of streaming revenues and higher costs, are concerts going to go away, or are we still going to see artists putting on these concerts all over Canada and other places?
Well, that's a really great question. I think there's a few things going on there. Like, there's the mega concerts like the Taylor Swifts, and they will continue to go on. But what is important to note at this moment in time, as we really think about how AI is going to impact culture broadly, one of the things that AI cannot and will not be able to replicate is the actual coming together of human beings to share an experience like music. So I think on the live side, especially for emerging artists and new artists, finding the places to play, finding places to bring your community together is vital. And it is the thing that I think you're going to see more and more of, because that is the actual value proposition for music.
And it's a difficult situation, because I know you hear a lot of musicians say that the only way they can make money is to tour, because they're not making money off their albums anymore. It used to be you made money off the album and you toured to support the album. It's reversed. But it's also become extremely expensive. And then throw in scalpers and the secondary market, whatever you want to call it. I call it scalpers still. With what the province of Ontario has brought in, do you think that will help? Will that make a difference on trying to keep ticket prices manageable?
I think it's a good step. I think it's definitely a good step. I think that you're right. Touring is expensive. Playing live shows is expensive. And below a certain threshold, it is, cost prohibitive, actually. But nonetheless, bands are still doing it. Entrepreneurs are out there opening clubs and sustaining live venues, and I think that's vital. The live nature, and I'm talking more of the grassroots venues and the smaller to medium-sized clubs where artists learn their craft by and large. Those are really key to the future of a vibrant and healthy and economically important music sector in Canada.
All right, I just want to get one more. You mentioned about AI, and I think that's a big question. My son hates AI. They won't listen to AI. Anything that has AI in it. Even artwork on the album covers, they won't listen to it. What kind of an impact is AI having on music already, and where do you see it going? How do you see it either incorporating it or fighting it?
Well, there's many different ways to look at this question of AI, and I think that we feel like we're in the early stages of trying to navigate these waters, and many companies, including the large major labels, have struck licensing deals with AI companies. I think licensing is the way to go. However, I think so many artists do not want to engage in it at this point in time. I think obviously for businesses, for Canadian music companies, they're going to want to find ways in which AI can be helpful for their businesses with regards to marketing, data analytics, and this sort of thing. But for music fans, I think it's really important that they know that the music they're listening to is made by human beings, has been written by human beings and sung by them. And I think we really need to ensure that that is always very clear. And frankly, it's not right now on many platforms. It's not clear.
That was Andrew Cash, president of the Canadian Independent Music Association. Coming up, we are talking to Christian Wheatbrook, CEO of Xanadu Live at the NASDAQ. That conversation's coming up right after this. Canadian quantum pioneer Xanadu Quantum Technologies has hit the public markets today, debuting on the NASDAQ and the TSX. So here to discuss how the dual listing could reshape the race to commercial quantum computing for Canada is Christian Wheatbrook, CEO and founder of Xanadu Quantum Technologies. Good morning. Thanks for joining us and congratulations.
Thank you again, and welcome from New York City from NASDAQ. It's great to be here.
I think, first of all, just for our viewers, pure play photonic quantum computing company. That's what your company is. Can you explain what that is?
Yeah, it's maybe a bit of a mouthful, but basically there's a few different ways to build a large-scale quantum computer, which is what we're all after. So far, though, one of the most promising, if not the most promising approach is using light or photons, which is what Xanadu does. And that's not represented before today on the public markets. There's other approaches. And so this is a really exciting time for Xanadu, for Canada, and really excited to be on the NASDAQ and TSX.
As you say, there is other approaches. So how is that different from like superconducting or trapped ion approaches, for example?
Yeah, you can think of building a quantum computer either out of two buckets, one using photons, which is what we're doing, or one using electrons, so electronics essentially. And the superconducting and neutral atoms and so forth fit into that bucket. So it's a very different way of doing it. The reason why we're doing it this way is we've essentially solved scalability, meaning the end vision is to have many quantum computers, smaller ones that are networked together. Xanadu is the only company or entity anywhere in the world that's actually solved that problem. We solved that last year. And the ability to operate and perform at room temperature, we're the only company that can actually truly say that. So there's a lot of benefits to using a light-based approach.
Let's talk about some of those benefits first of all. What are they?
Yeah, room temperature computation is really important. We do need some cooling, but it's really at the very start of the computation, before the computation even starts. And so after that, the qubits, the gates, and the measurements, all at room temperature, and that allows us to save a lot of money, allows us to move much faster. The other big one is scalability, is achieved through networking. Photonics is really ideal to do that, and we're the first to have achieved that. And finally, when it comes to mass manufacture of the chips, we can actually work with, and in fact we do work with, a lot of large-scale chip foundries out there in the world. And so we're one of the few companies that can actually say that, particularly when it comes to high-volume manufacturing. We're in a key position there.
And what does quantum computing actually help with that people can see in their everyday life? Like I was reading, it can help with new drugs, it can help with certain types of batteries. Is that right?
That's right. These are the things why we're excited, investors are excited, and it's really great to be part of a field that's really going to revolutionize industries such as, like you mentioned, drug discovery, pharmaceuticals, material design. So we're actually working on next generation batteries. How do you ultimately create a battery that's 10 times faster to charge, 10 times longer range on a single charge, while still maintaining its safety properties? And then also next generation solar cells as well. Beyond that, artificial intelligence, finance, and so forth. So very big industries that will ultimately affect everyone in the world.
This is the first publicly listed pure play photonic quantum computing company, right? Your company, you're listed now on the NASDAQ and the TSX.
That's right.
I wonder, what does that signal about the industry and where it's headed?
Yeah, I think it's signaling to the industry that we're not too far away now from the end vision of having a large-scale quantum computer. We publicly stated that we're aiming to achieve that in 2029, 2030, and build our first, what we call a quantum data center in Canada, in Toronto. And I think the other thing this signals is, from what we've been told, this is the first quantum tech company to be listed in the last 4 or 5 years on TSX as well. So hopefully we're starting to sort of the next momentum, next wave of quantum tech stocks on TSX. So it's an exciting day overall.
In terms of that dual listing, like what does each market give you in terms of like investor access and visibility?
Well, first off, we're proudly Canadian, so it was never a question of whether we should be dual listed. We're proudly Canadian, we're getting a lot of government support, and we want to show our support for Canada too by being listed on the TSX. And that's important to us. It also hopefully will open up, there's pension funds, large pension funds in Canada. Hopefully they'll start to take more of an eye on us, given some of them have the mandate to invest more in Canada. So I think the access to capital and the proud nature that we have of being Canadian go hand in hand.
And when it comes to talent, like how does Canada stack up, and who do you compete with the most when it comes to actually attracting talent?
Yeah, it's a good question. We often hear about the brain drain. I think Xanadu has done well by having the brain gain. I founded Xanadu in 2016, and since then we've got nearly 300 folks. Roughly half of them actually come from Canada, and the other half come from overseas. So I don't think it matters where you are. If you collect really, really awesome people and awesome talent and put them together, it automatically attracts some other really great people from around the world as well. We also have folks in the US, Australia, and Europe, and so we're well positioned to be one of the leaders, if not the leader, in quantum computing over the next few years.
And you're also already working with a number of companies, is that right?
Yeah, we work with a lot of companies. So we work on the chip designs of the photonic integrated chips. We design them ourselves and send them off to different foundries around the world. Once we get them back, we do everything ourselves. But the foundries are different parts of the world. There's like 3 in the US we work with, so that supply chain is very strong. But also from the commercialization side of things, we work with Volkswagen, BMW, Rolls-Royce, Toyota, and many others, working on the applications that I mentioned for next generation batteries and so forth.
Interesting stuff. Okay, we will leave it there. That was Christian Wiedbroek, CEO and founder of Xanadu Quantum Technologies. Appreciate your time this morning. Thanks so much. Up next, it's time for Hot Picks. We will zero in on 3 plays in the entertainment sector right after this. Stay with us. It's time now for Hot Picks, and today we are zeroing in on the entertainment sector. Our next guest has Live Nation as his top pick, a company that recently settled an antitrust lawsuit with the U.S. Department of Justice. So here to tell us more is Ian Moore, Vice President and Research Analyst at Bernstein. It's good to have you join us this morning. Thanks so much.
Yes, I'm Ian Moore. I cover several music and sports-linked equities for Bernstein. The majority of them are facing some pretty serious disruption narrative pressure, including a flood of AI-generated music. But the live category here is completely unassailable. No one wants to watch Sora create fake cars, driving around a racetrack at 250 miles an hour. A screen can never replicate the pure electricity of being front row at a BTS or a Bruno Mars concert. And no video will ever do justice to the 2 elite athletes beating the absolute brakes off each other in front of a roaring crowd. This is why live entertainment really stands alone as the scarcest, most irreplaceable asset in media today, in my view, and why the entire category, including Live Nation, but also including the TKO Group, Liberty Media, Formula One Group, should see meaningful multiple expansion this year.
Yeah, no kidding.
The Iran situation.
Let's go through the hot picks one by one. I know you just listed them, but let's start with Live Nation and break down exactly why you like Live Nation. I take your point that people just love live TV, right? Like there's nothing quite like it, but let's start with Live Nation. What do you like about it?
Absolutely. So as you mentioned, one of the biggest uncertainties in the past year has been the long-running DOJ antitrust complaint, which even raised the possibility of a breakup of this company. Earlier this month, Live Nation announced what I view as a very favorable settlement in that case. Stock popped initially, but has given a lot of that back. Trades below $150 a share today. The terms of the settlement create roughly a $50-60 million annual financial impact, in my view. view, that's very manageable for a business that I see doing close to $3 billion of adjusted operating income next year. And what really matters is that Venue Nation, their network of owned and operated locations, is untouched, highly profitable across F&B, food and beverage, other ancillary, growth opportunities. I've done some differentiated work here that pulls on over a decade of individual tour dates, gross ticket sales. That granular analysis gives me confidence in a path to double-digit adjusted operating income growth in 2026. And the touring pipeline is simply filling faster for this year than it has in the last 2 years. So my price target's $200 a share. That's 30% upside to the current price. In a year with some serious macro uncertainty tied to Iran, Live is a clean, predictable compounder in my view.
Okay, and next up, you also like TKO Group. Why is that?
Yeah, TKO. So last year they locked in a slew of major media rights renewals. That's created a clear opportunity for a free cash flow inflection. The Iran situation's added some near-term volatility here. I did some deep work last week on content monetization, though, and I highlight that the longer-term setup is highly compelling and unchanged here. So using some cross-sectional sponsorship regressions across every major sports league, I showed that media rights growth drives partnerships with a 2-year lag and an 80 to 90% pass-through. That monetization gap that exists today between the UFC, WWE, and some of the larger leagues like the NBA and the NFL, with continued execution on category diversification, my analysis points to TKO hitting management's $1.2 billion partnership target as early as 2028. So that's 2 years ahead of their own guidance. Zuffa Boxing, that's their boxing promotion that they're in the process of building up. Adds another layer of optionality in my view. Streaming's displacing PPV all across boxing, enabling multiple supercards every year, bigger audiences, preserved live financial incentive economics. I see potential for hundreds of millions in incremental EBITDA from Zuffa by 2030. The stock's sitting around 191 today, 189-ish right now. My target's 250, so that's over 30% upside. Even with this curveball in Iran, TKO is the most concentrated partnership and sponsorship inflection story in sports. And if you believe, the Iran conflict comes to a resolution this year, the stock's very cheap.
Yeah, and Formula One as well. I believe they've actually canceled some races in the Middle East because of what's happening, but you still like Formula One. We don't have a lot of time left, but tell us what you like about Formula One.
Yeah, just very quickly, I upgraded this stock back in January. I see the F1 calendar shifting toward higher paying markets. Apple is poised to invest aggressively in F1, and the opportunity to apply the F1 playbook to MotoGP adds, 300 million or more of EBITDA by 2030 here. The Iran situation, as you mentioned, it's been the big curveball. Bahrain, the Saudi Grand Prix on the F1 side, and the MotoGP Qatar race have all been canceled. The stock's pulled back to 83. In the note I published just yesterday, though, I did some bottoms-up scenario analysis. The current price really, in my view, reflects more than a few months of disruption. In fact, at today's valuation, stock's pricing, a really drawn-out conflict, even a complete wipeout of races in the region in the second half of this year. So if the conflict eases by June or in the next 10 days, this could be a very compelling long-term buying opportunity. Price target's 110, 30% or more upside.
So interesting. All right, we're going to have to leave it there. Ian Moore, Vice President and Research Analyst at Bernstein. Appreciate you coming on. Thanks so much.
Thank you.
Up next, we will turn our focus back to IPOs because the mother of all IPOs and the one everyone's waiting for, SpaceX, the most valuable private company on the planet, may soon file for an IPO. We'll get the latest. SpaceX is set to hold briefings with prospective IPO investors in April. That's according to people that are familiar with the matter. And to discuss its valuation target, for more, we're joined now by Bloomberg's industrials and transport reporter, Keel Porter. Keel, it's good to have you join us. This is incredibly interesting, I'm sure, for a lot of investors, too, who have maybe been waiting for this for a while. What do we know so far?
Well, this will very much be the next step, provided SpaceX files confidentially, which, as we expect, should happen imminently. That allows them to move to the next stage of the initial public offering process, which will be more intense meetings with investors, giving them a sense of how the valuation is going to be approached, where the company sees its growth coming from, what its debt profile is going to look like going forward, what its executive team is going to look like, essentially filling in the blanks for people who are considering to invest.
I wonder how Elon Musk is going to fold into all of this. Has there been any talk about his position in all of this?
Well, it's very much seen that he's going to be leading the company along with all the other companies that he's currently the CEO of. There's also been discussions about what type of shares he's going to own, whether his shares will have proportionally more weight than other investors. That's still being discussed at the moment with the banks. However, it does very much seem to be there's going to be a special type of share for Elon and perhaps other members of the executive team.
SpaceX said to target as much as $75 billion in this IPO. How does an IPO change a company, particularly one as big as SpaceX?
Well, you have to start opening up the kimono, frankly. SpaceX has been private for 20 years, and even some of its largest investors would only get 2-3 pages of information with the company's preferred metrics. Once you go public, you have to start showing what your revenue is, what your losses are, if you're having any. And XAI, from everything that we've been told, is losing upwards of $1 billion a month. So how they're going to show the growth profile of the rest of the business coupled with a unit that is loss-making will certainly be very interesting to see.
Where does most of the revenue for SpaceX come from right now? Do you know?
The launch business and the Starlink business are currently the two main drivers of revenue within the company.
Okay, so how long could this take? I understand it's only reports at this point, but I mean, is there a rough timeline that you've been hearing, at least even just like rumblings of?
There's a target of June. Which, if they're going to reach, they need to get the confidential filing put in now, because to do roadshows of this type, especially with the amount of capital that you're looking at raising, you are into the 12 to 14 week zone. You extrapolate that out, that's June. And once you start getting later into the year, you're into like third quarter. Investors usually like to see companies of that type perhaps give an indication on what next year's results are going to look like. And then SpaceX is going to have shown that the growth that they promised was already in the books. So if you want to do it to the current timetable, you really need to get that S1 in as soon as possible.
And this would be a record IPO. What does that tell you?
Elon likes to reach for the stars, both actually and metaphorically. It's more than double what's ever been raised. The sheer market mechanics of that are very interesting to see. You've got a huge banking syndicate that's being built for this. There's also talk of a retail component of up to 30%. That's upwards of $20 billion you're trying to get into the retail market. Getting enough companies and enough individuals interested and ready to go for that is a challenge in and of itself.
Okay, we'll leave it there. That's Bloomberg's industrials and transport reporter, Keel Porter, joining us live. Keel, thanks so much for that.
Thank you.
And before we end the show, let's take a look at how the markets have done so far this week. We've got a 1 week chart of the TSX because the TSX was seeing a lot of gains this week, but it's falling today. So over the last week, up by 0.2%. But again, we're seeing the TSX fall today, as well as U.S. markets, as investors very much cautious, very wary of what could potentially be going on in the Middle East, and potentially a longer war than what we expected. We've got a 1 week chart of the S&P 500 as well. We'll take a quick look at that. It's down by 0.8%. So U.S. markets really seeing some lows that they haven't seen in months. And that seems to be continuing as investors very much not sure about what's going to happen. The NASDAQ down by 1.2% at the moment. Look at that drop off ever since the end of the day yesterday and continuing into today. That wraps up this edition of The Open. We've got morning markets coming up next.